In this video, I'm going to discuss potential tax changes that are on the horizon with a Trump White House and a Republican Congress. So stay tuned for 11 areas that I'm going to cover, which may have some potential changes coming up in the new year. Welcome back. This is episode 230. It's less than 60 days until we will have a new president in the White House and a new Congress. And many people are concerned about what impact this may have on their finances, what impact this may have on their taxes. So in this episode, I want to cover 11 areas that have some potential changes on the horizon under a Trump White House and a Republican-controlled Congress. As a reminder, my goal with these YouTube videos and my podcast is continue to educate people on the issues they're facing regarding retirement planning, investing, and tax planning. And if you want to stay up to date on this information, then consider signing up to receive my weekly email where I keep you abreast of this very information. To sign up for my weekly email, head over to retirewithryan.com, scroll down, and click on sign up for my newsletter. So it's known now what the results of the election are. President Trump is being reelected, and we have a Republican-controlled Senate and a Republican-controlled House, which means it's highly likely that many of the things President Trump has campaigned on and talked about on the campaign trail will likely go into fruition. So I want to talk about 11 of the most commonly discussed areas and what those potential changes are. And I'm going to start with the areas that are least likely to have change, then move up to the areas with a moderate amount of change, and then finally wrap up with the areas that have most likely the most change coming from them. So be sure to listen to the end of the episode where I cover those most likely to change areas. So area number one with a low amount of potential change are individual tax brackets. And currently we're all paying our taxes underneath the last Trump era tax cut, the TCJA tax cuts that went into place in 2017, and those are set to expire at the end of 2025. So likely because Trump and Republicans were the architect for this tax plan, there's probably not any major changes that are going to be coming about with regards to the tax brackets. So most likely the tax brackets will stay about the same. There'll probably be some moderate changes to adjust for inflation, but the highest brackets will most likely not be going up. That is something that Democrats and Kamala Harris talked about repeatedly, how they were going to raise tax brackets for the richest Americans and even potentially for middle-class Americans. So the good news for all U.S. taxpayers is that we will most likely not be seeing any increase to tax brackets coming about under a Trump administration. Area number two is the standard deduction. So this is also an area that is most likely not going to change. This was increased significantly under the tax era, the Trump tax cuts in 2017, and most likely that will not be changes. Most likely not be having any major changes for either a single or a married couple filing jointly. Area number three is estate tax exemptions. This is also an area of low change. So currently, the federal estate tax limit is $13.6 million per individual. That means that a married couple could double that number and pass away with that amount of value of their estate, and they would not pay any federal income tax. Any estate over that is taxed at a rate of 40%. That number next year is actually going up to $13.99 million. So this is not an area that Trump has talked about, not an area that Republicans have focused on. So most likely this will not be seeing any major changes, maybe just some slight future increases for any inflation adjustments. Area number four is itemized deductions. So this might see a little bit of change. This is an area of moderate change. So something that was taken away a number of years ago, which relates to my profession, is that you were able as an individual to deduct the amount you paid to your investment advisor. So if you had non-retirement accounts, you were paying your investment advisor a fee to manage those accounts. That was a deductible expense that you could actually itemize. So it's possible that might be coming back. So that would be a big win for people that are paying out of pocket for investment management and or financial planning related advice. So we'll have to stay tuned to see what happens with that. And there's also been talk about being able to itemize auto loan deductions. Currently, unless you own a small business, you're not able to either deduct the cost of mileage or any maintenance costs, or I should say you're able to deduct the cost of mileage or maintenance costs for your vehicle, but you cannot actually deduct the interest you pay on auto loans. So that's something that might be coming back. Area number 5 is child tax credit. So this is something that Democrats talked a lot about, expanding the child tax credit. Well, it is something that Republicans have talked the opposite about, most likely reducing the threshold where people qualify for a child tax credit. So it may be applying to less people, but they also at the same time might increase the maximum credit. Area number 6 is alternative minimum tax. So this is a tax that, unfortunately, if you find yourself in a higher tax bracket, but you're able to lower your income through a number of deductions, sometimes it happens that you have to add back those deductions, and even though you might find yourself in a lower tax bracket, you end up paying tax at a higher rate according to the AMT or alternative minimum tax. So it's possible that the exemption around this might be actually reducing. So more people might be triggering alternative minimum tax, but there might also be some ties to this is something I'll talk about at the very end, which is relating to the SALT tax, which is something that makes it difficult for many people in high tax states to be able to itemize their taxes. So that could go hand in hand. We'll just have to wait on that. Area number 7 is known as Section 199A depreciation. So these are for people that run small businesses. So currently, if you run certain types of small businesses, you're able to deduct 20% of the business profit on your tax return. So this is significantly helping a lot of people get an additional deduction on their taxes if you run a small business. And this is an area that was talked about heavily that could have been going away under a Democratic-controlled White House and Senate or Congress, but it's looking like that is actually going to stay with under a Trump administration and Republican Congress, and it actually might be increased. So the percentage that you can deduct, it's possible that that could be increased. So that could be a big win for people that run small businesses. Area number 8 is other business deductions. Currently, there's a number of things that you can deduct as a business owner, and one area that might be increasing is being able to immediately expense any costs that you have for research and development. So this is something that could be a big win for businesses, even small businesses that do a lot of research. You could immediately deduct those expenses in the same tax year. And another thing that might be reintroduced is something called bonus depreciation. So this went away a couple years ago, and the most common example I would use for this is that if you bought a new vehicle and the vehicle was for business use, usually I think the vehicle had to weigh over a certain amount. It was around 6,000 pounds. And let's say you paid $60,000 for that vehicle. Well, a couple years ago, you could deduct 100% of that vehicle cost in the same tax year. Well, that went away, and there's talk about that actually coming back. Well, that bonus depreciation went away, but there's talk about that coming back. So that applied to vehicles. It applied to equipment as well. So that could be a good thing if you're a business looking to buy some equipment, looking to buy a vehicle. That would give you an additional deduction on the same year that you purchased that vehicle. Rather than writing it off over a number of years, you could deduct that all in 1 year. Area number 9 would kind of fall under other tax cuts. This is a medium change, and this has been talked about repeatedly by candidate, soon-to-be President Trump. He wants to eliminate tax on tips. He wants to eliminate tax on overtime pay and even eliminate tax on Social Security. So this is something that I've talked about before. I am of the opinion there's a low likelihood that elimination of tax on Social Security for all Americans is something that we'll see, because where would that extra revenue come from? But currently right now, if as an individual, your income as calculated for Social Security taxation, which takes your income for the year, excluding Social Security, then plus half of your Social Security, if that number is under $24,000 or under $34,000 as a married couple filing jointly, you include zero of your Social Security income in your income tax. So essentially you pay zero tax on that. Once you go over $24,000 or $34,000, now you include half of your Social Security you receive on your tax return. And then the next bracket is $34,000 for individuals and $44,000 for married couples filing jointly. And then you would include up to 85% of your Social Security in calculating your taxable income. So maybe that number could be expanded. That's something that hasn't been expanded since the 80s, since the last major changes were made to Social Security. So maybe something like that is increased. So we'll have to wait and see on that. So now we're moving into our areas of most likely high likelihood of these things happening and a high amount of change. So one area is clean energy tax cuts. That's area number 10. So that means tax credits for solar panels, home efficiency upgrades like windows, certain heating systems. Those could be going away because that's definitely an area that Republicans historically are not as keen on. As part of that, this is an area that President Trump has talked about repeatedly, and even the founder and owner of one of the largest electric car companies in the world, that's Elon Musk, an owner of Tesla, has talked about eliminating the $7,500 tax credit for electric vehicles that you get when you purchase an electric vehicle. You also get that in some hybrid cars. You can qualify for that as well. And that is income-based. A couple of years ago, everyone could qualify for that. Now there are income limits based off whether you're a single or a married couple filing jointly tax filer. So that could be totally going away. So if you are looking to benefit from those clean energy tax credits, whether it be solar panels, a new heating system, certain windows qualify, or you're thinking of buying an electric or hybrid vehicle, maybe you want to do that before the end of 2024 because it's unclear with any of these tax changes how they go into play. A lot of times they don't become effective until the following year. They're passed. Sometimes they could be effective retroactively. Sometimes they could be effective immediately upon their passing. So in either case, January is coming quickly, and President Trump will be taking over the White House. We'll have a new Congress. It's unclear how quickly they'll move on these things, but if you're somebody who's looking at doing that, then maybe it could be a good time for you to do that to make sure you still get that tax credit for a new vehicle or certain upgrades to your home. And our last area that's most likely has a high probability of having some change, and that's area number 11, and that would be related to SALT tax deduction cap. So what is a SALT tax? Well, that's the state and local tax that people are able to deduct on their tax returns that live in high tax states. So I live in Connecticut. It's notoriously one of the highest tax states in the country. States in the Northeast, states on the West Coast have high property tax, have also high income tax. So historically, you were able to add up your state and local tax. So how much did you pay in property tax for the year? Let's say it was $10,000. How much did you pay in income tax? Let's say it was $20,000. And you can add those two together, and you could then use that to itemize your taxes. That would be an itemized expense, which for many people allowed them to itemize their taxes and take a greater deduction than the standard deduction. Well, as part of the TCJA Tax Act of 2017 that Trump passed, a cap was put in on those state and local tax. You're probably very familiar with this if you are in a high tax state, because for many people in those high tax states, myself included, I ended up paying higher taxes after the Trump tax cuts because of that limitation. Well, it's been talked about that will be increased. So that could be raised over $10,000 because it's a very low amount. Many people in high tax states, just their property tax alone is close to, if not more than $10,000. So maybe that limit is raised. It also could be indexed to inflation. It also could be doubled for joint filers. So instead of $10,000, if you're a joint filer, maybe you get $20,000 or $30,000. Or it could be completely eliminated. So hopefully there'll be some change and there'll be some relief for people in high tax states, because very few people now are able to itemize their taxes. Most people are taking the standard deduction, which in itself did increase, and tax brackets went slightly down under the TCJA. So that was definitely a windfall. But where a lot of people ended up paying more taxes was because they were limited into the amount of state and local taxes they could use to calculate whether or not they could itemize their taxes. So that is an area that most likely will see some change. And regarding that, one thing that you could do, if you are in a high tax state and you pay your state income tax through quarterly estimated tax payments, maybe you could wait until after the first of the year to make that payment. Therefore, if it occurred in 2025, you might then be able to use that as an additional expense to be able to itemize your taxes in 2025 if that change ends up coming into play. So I'm not telling you to pay your taxes late, but estimated tax payments are usually due by the 15th of January. So sometimes accountants will recommend paying those early in the previous tax year because it gives you a greater amount to deduct as a business expense. But it could also give you a greater amount to deduct if you're able to then itemize your taxes in 2025 and years beyond. So something definitely to think about. So I hope that you found this helpful on my rundown of the 11 areas that are likely to have a low probability of change and then a high probability of change under the new administration that'll be coming into the White House and Congress shortly. And as always, if you have a listener question you want to have considered for a future episode, you could head over to retirewithryan.com and click on Ask a Question. And while you're there, consider signing up for my weekly retirement and investment newsletter. Have a great week, and I look forward to talking with you next Wednesday. Take care.